assets backing method, so we will be just calculating the value of assets which is available for the equity shareholders. We just have to deduct the preference capital and the preference dividend, and whatever is the balance left over, so that is to be divided among the equity shareholders. Amalgamation means the coming together of two companies. So one and two companies which merge together and form one company, so that is called as amalgamation. Hello everyone, I am Purnima, faculty in the Department of Commerce and Management, Vidhyaashram First Grade College, Temple of Excellence, MYSURU. I welcome you all to this session. In this session, we will be having a discussion on the chapter Valuation of Shares. Now, what do we mean by valuation of shares? So, in this valuation of shares, we will be evaluating the share value of the companies. Now, there are different methods of valuation of the shares. Now, in this, the first method discussed is the asset backing method. Asset backing method or the net assets method. Under the net assets method, the value of the equity shares is calculated on the presumption that the company would be wound up. So, when do we value the shares? So, valuation of shares take place when the company is being wound up or when it is being liquidated. To ascertain the value of each equity share, the following procedure is followed under this method. Now, under the asset backing method, we have the following procedure. First, the market values or the present values of all the assets of the company, including the goodwill, are added up. The resulting sum is the gross market value of all the assets. Then, secondly, from the gross market values of all the assets, the total amount of all the liabilities payable to the outsiders should be deducted. Then, the balance is the value of the net assets available for shareholders, the asset backing for the shares of the intrinsic value of the shares. So, thirdly, from the value of the net assets available for the shareholders, the total paid up preference share capital and arrears of preference dividend if payable should be deducted. The resulting balance is the value of the assets available for the equity shareholders. Now, in this assets backing method, so we will be just calculating the value of assets which is available for the equity shareholders. So, whatever is the net asset value available, first we will have to distribute it to the preference shareholders, then deduct the preference dividend, and whatever is the balance left over, so that should be divided among the equity shareholders. Lastly, the value of the net assets available for the equity shareholders should be divided by the number of shares. The resulting amount is the intrinsic value of the equity share. So, whatever the amount you get, so that is the intrinsic value of the equity shares. Then, the next method is the yield method or the dividend yield method. So, under this method, the average annual profits of the company are determined on the basis of the available data. So, what is the average annual profits of the company? So, that will be determined, and based on that, we have from the average annual profit of the company, the provision for income tax and appropriation towards general reserve and debenture redemption reserve are made. Now, from the earnings of the company, we deduct the provision for tax and general reserve and debenture redemption reserve. Then, thirdly, from the balance of the average annual profits, the fixed dividend payable to preference shareholders is deducted. The balance is the average annual profits available for dividend distribution among the equity shareholders. Again, we just have to deduct the preference capital and the preference dividend, and whatever is the balance left over, so that is to be divided among the equity shareholders. So, after ascertaining the average annual profit available to equity shareholders, we have to calculate the expected rate of dividend or the return on equity shares. This can be calculated by applying the following formula. So, the average annual profit divided by total paid up value of the equity shareholders into 100. So, with this, be able to find out the ERR of the company. Then, lastly, After knowing the expected rate of dividend, the market value of each shareholder on the yield basis has to be calculated by the following formula. So that is expected rate of dividend, or we also call it as the ERR and the NRR. NRR will be usually given in the problem into the paid up value of each equity shareholder. So what do we mean by the paid up value? Suppose the face value is 100. Then if the shareholder has paid only 80 rupees of this 100 rupees, then we call the paid up value as 80 rupees. So into the paid up value of each equity share. Then next we have the earning capacity method. So under this earning capacity method, the following procedure has to be followed to calculate the market value of the share. The rate of earning of the company has to be calculated. So the rate of earning can be found out by total profit earned by capital employed into 100. So whatever is the profit earned by the company divided by capital employed into 100. So with this we get the earning capacity method. Then the market value of the shares of the company on the basis of the earning capacity of the company can be calculated by rate of earnings by NRR into paid up value of the each equity share. Then next, valuation of shares. So when can you value the shares? What is the need for, what are the circumstances under which the valuation of shares is necessary? The circumstances which necessitate the valuation of shares are at the time of amalgamation or absorption for adjusting the rights of shareholders. Now what do we mean by amalgamation? Amalgamation means the coming together of two companies. So one and two companies which merge together and form one company. So that is called as amalgamation. Now what is absorption? In this absorption, one company is absorbing another company. So when two companies are in similar business, the stronger company will absorb the smaller company in order to avoid competition. So that is what we mean by absorption. So when there is amalgamation and absorption, there is a need for valuation of shares. So when a large block of shares is purchased to acquire the controlling interest in a company. So when a large block of shares, suppose there is one shareholder who is purchasing a large block of shares in order to have the controlling rights, then we need to value the shares. When the shares of one class are converted into shares of another class. So that is preference shareholders are converted into equity shareholders, then we need to value the shares for estate duty and wealth tax purposes. So whenever for tax purposes also we need valuation of shares. For the determination of security margin when shares are offered as security for loans and advances. So whenever the shares are offered as security as a collateral to the bank for the loans, then we need to value the shares for the determination of the amount payable to the dissentient shareholders for the acquisition of their shares when the company is sold to another company and one of the shareholders of the selling company dissent. Now, who is a dissentient shareholder? So, these dissent shareholders, they are opposing the takeover of the company or the sale of the company. So, under such circumstances, the shareholders' amount will be paid to them. So, in order to see that what is the amount to be payable to these shareholders, there is a need for calculation of or valuation of the shares. So, when a company is nationalized, so that is it is taken over by the government, then also there is a need for valuation of shares for the valuation of assets of finance or investment companies. So, for the assets of the finance and investment companies, it is necessary for valuation of shares of such companies. Now, here we have one problem here. Suraj Limited has 50,000 equity shares of rupees 10 each and 40,000 7% preference shares of rupees 10 each. The company transfers 10% of the divisible profits to general reserve every year. The expected profit before tax is 10 lakhs and the rate of tax is 65%. The normal rate of dividend is 16%. Find out the market value for equity shares. Now, we have to find out what is the market value of the equity share. Now let us see what is the equity share capital here. So what is the number of shares here? 50,000. So this is the equity shares here. So 50,000 into 10, that comes up to 5 lakhs. So this is the equity share capital, and 40,000 7% preference shares. So preference shares will be 40,000 into 10. So value of each share is 10 rupees. So that will be 4 lakhs. So this is the preference share capital. Then 10% of the divisible profits is transferred to the general reserve, and the expected profit before tax is PBT. It is how much? 10 lakhs. And then the rate of tax is 65%. Then the NRR is 16%. So we have to find the market value of the equity share. Now here, for the valuation of shares, first thing is we have to calculate the ERR, that is the expected rate of return. Now for calculating the expected rate of return, first thing is we have to calculate what is the profit available for equity shareholders. So what is the profit available for equity shareholders? So we have to calculate that. So for that we have to see what is the profit given. So what is the profit before tax given? 10 lakhs. So in order to calculate profit available for equity shareholders, so first thing is I will want profit before tax. Now what is the profit before tax? 10 lakhs less tax. What is the rate of tax given in the problem? 65%. 65%, that is so out of 10 lakhs I am deducting 6 lakhs 50,000. I am getting 3 lakhs 50,000. Now from this, company transfers 10% of the divisible profits to general reserve. So I have to transfer 10% of this to general reserve. So out of 3,50,000, I deduct 35,000. I get 3,15,000. Now this 3,15,000, this is the profit available for shareholders. Profit available for distribution among the shareholders is 3,15,000. Now from this we have to deduct less provision for dividend to preference shareholders, that is 7% into 4 lakhs. So that will be 28,000. So when you deduct this, you get 2,87,000. So this is profit available for equity shareholders. So we have the profit available for equity shareholders as 2,80,000. So First thing is profit before tax is 10 lakhs. So rate of taxation is 65%. So 6,50,000. So I deduct 6,50,000 from 10 lakhs, I get 3,50,000. From this, I deduct 35,000, that is 10% of that. I get profit available for shareholders is 3,50,000. From this, I deduct the preference dividend 28,000. So profit available for equity shareholders is 2,87,000. Now I have to calculate the ERR. So in order to calculate the ERR, so ERR will be equal to profits available for equity shareholders divided by paid up equity capital into 100. So the profit available is 2,80,000. I have to calculate the ERR. So the ERR will be profit available divided by paid up equity capital into 100. So profit available is 2,87,000. The paid up equity capital is 5 lakhs into 100. So when you just simplify this, we get we are getting 57.4%. So the profit available divided by paid up value of equity capital into 100. So 2,87,000 divided by 5 lakh into 100. So that comes up to 57.4%. Now the next will be so this will be equal to 57.4 divided by NRR. NRR is 16 to paid up value of the share. So we have the value of the share as 35.87. Next, we have to calculate on the dividend yield method. Here it will be dividend per share by NRR into 100. So the dividend per share by NRR into 100. Now what is the dividend per share we have calculated? So this is 57.4. This is for 100 shares. So it will be, so dividend equals profit available by number of shares. So this will be equal to, what is the profit available here? 2,87,000. So 2,87,000 divided by the number of shares is 50,000. So that will be 5.74. Now what is the dividend per share? 5.74. So this will be 5.74 divided by NRR is 16 into 100. So when we simplify this, we get the answer as again 35.87. So the dividend yield method, so you have to calculate dividend per share divided by NRR into 100. So the dividend equals profits divided by number of shares. So 2,87,000 divided by 50,000, we get 5.74. So whatever is the dividend divided by the NRR into 100, we get the value per share. So as per the dividend yield method, we get the value of share as 35.87. Now the next problem, Mr. Rajesh holds 5,000 equity shares in Bajaj Limited, the paid up value of which is 30,000 equity shares of ₹1 each. It is ascertained that the normal annual net profit of the company is 5,000. The normal rate of return is 8%. Mr. Rajesh requires you to value his share based upon the above figures. So, here Mr. Rajesh has 5,000 equity shares in Bajaj Limited. So, the equity share capital, what is the value of the equity share capital here? In this company, 30,000 into 1. So, 30,000. So, this is the equity share capital. Now, out of this, Mr. Rajesh holds 5,000 worth of shares. So, 1 rupee share 5,000. So, it is ascertained that the annual net profit of the company is 5,000 and the normal rate of return is 8%. So, you have to value the share. Now, the first step is profit available for equity shareholders. So, in the absence of any other information, we assume that the given profits are the profits available for equity shareholders, that is rupees 5,000. Then, next is we have to calculate the ERR. So, the next step will be ERR. Now, how do we calculate the ERR? ERR will be equal to so the NRR is 8%. So, the profit available for equity shareholders is rupees 5,000. The ERR equals profit available by total paid up equity capital into 100. So, the profit available is 5,000 divided by total paid up equity capital 30,000 into 100. I get 16.667%. The value per share is ERR by NRR into paid up value. That is 16.67 divided by 8 into 1, that comes up to 2.08. This is the value per share as per the yield method. Then dividend yield method, we have the dividend per share by NRR into 100. Now, to calculate the dividend, we have the profits divided by number of equity shares. The profits is 5,000, number of equity shares is 30,000. So, it comes up to 0.1667. So, when I substitute the values here, so 0.1667 divided by 8 into 100, so 2.08, this is the value per share. So, this is the answer. So, with this, we come to the end of this session. Hope you have all followed it. Thank you.